Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Apogee Enterprises, Inc. quarterly report. Apogee Enterprises, Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $1 billion. Apogee Enterprises, Inc. trades at a lower price-to-earnings ratio of 17 times and a lower price-to-book ratio of 1.34 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 58% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 3.24%. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. Apogee Enterprises, Inc. offers a diverse range of businesses and services that cater to the architectural needs of various industries. At its core, the company provides architectural products and services for enclosing buildings, as well as glass and acrylic products used for preservation, protection, and enhanced viewing. The company operates in four main segments: architectural metals, architectural glass, architectural services, and performance surfaces. The architectural metals segment designs and manufactures aluminum window, curtain wall, storefront, and entrance systems under various brands such as Tubulite, EFCO, Linetec, and Alumicar. The architectural glass segment cuts, treats, coats, and fabricates glass for custom window and wall systems under the Vurekin and Glassec Vurekin brand names. The company's architectural services segment integrates technical services, project management, and field installation services to design, engineer, fabricate, and install architectural curtain wall systems and other facade-related systems. The performance surfaces segment develops and manufactures coated materials for various applications, including wall decor, museums, graphic design, digital displays, architectural interiors, and industrial flooring under brands such as True View, Resin DEK, RDC Coatings, Chromolux, and Unisub. The company's products and services are primarily used in commercial buildings, institutional buildings, transportation facilities, and multi-family residential buildings. Apogee Enterprises markets its products and services through a direct sales force, independent sales representatives, distributors, glazing subcontractors, general contractors, retail chains, and an independent distribution network. With over 70 years of experience, the company has established itself as a leading provider of architectural products and services in North America. The stock price of Apogee Enterprises, Inc. has significantly dropped by approximately 48% over the past year due to several key events. One major factor was the company's Q3 fiscal 2026 earnings miss, where it reported adjusted EPS of $1.02, falling short of analyst estimates. This led to a decline in revenue and a reduction in full-year guidance, with Apogee Enterprises lowering its adjusted EPS forecast to $3.40-$4.50. The lowered outlook was attributed to several factors, including a highly competitive pricing market, increased aluminum costs, and the impact of tariffs. As a result, the company's profitability was squeezed, with the net profit margin decreasing to 3.2% from 7.6% a year earlier. This decline in profitability and reduced guidance led to a significant drop in Apogee Enterprises' stock price, making it one of the primary news events contributing to its decline over the past year. The combination of these factors has had a substantial impact on Apogee Enterprises' stock price, leading to a 48% decline. The company's inability to meet analyst estimates and its reduced guidance have raised concerns among investors, resulting in a significant drop in its stock value. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted a company's financial performance. On the positive side, revenue growth has been driven by several factors. Net sales have increased, with a notable rise in the architectural metals segment and performance surfaces segment. The acquisition of UW Solutions has also contributed significantly to revenue growth, with an increase of $65.3 million. Additionally, there has been an increase in volume and favorable mix in the architectural glass segment. On the other hand, revenue decline can be attributed to several factors as well. Net earnings have decreased by $45 million, and operating activities have provided net cash that is lower than previous years. Capital expenditures have also been a significant use of cash, totaling minus $18.3 million. Furthermore, lower volume and price due to lower end-market demand in the architectural glass segment has contributed to revenue decline. The dilutive impact of lower, adjusted EBITDA margin from the UW Solutions acquisition in the performance surfaces segment has also had a negative effect on revenue growth. The net income of the company experienced a significant decline in both quarterly and yearly comparisons. In November 2025 compared to November 2024, the net income decreased by $8.3 billion year-over-year, from $12.2 billion to $3.9 billion. This downward trend continued throughout the year, with a year-to-date decrease of $45.1 million in 2025. The profit margins also suffered a decline, with both gross and operating income margins decreasing quarter-over-quarter and year-over-year. The gross profit margin dropped from 26.1% to 23.7%, while the operating income margin decreased from 8.3% to 7.1% on a quarterly basis. On an annual basis, these margins declined even further, with the gross profit margin falling from 28.1% to 23.7%. The reasons behind this decline in net income and profit margins are multifaceted. Lower prices and reduced volumes contributed significantly to the decrease. Additionally, higher costs associated with materials, health insurance, and restructuring efforts put pressure on the company's bottom line. Furthermore, an increased tax expense for discrete items also played a role in the decline. These factors combined to result in a substantial decrease in net income and profit margins. The company's financial performance indicates a strong ability to generate cash from its core operations. According to the extracted summary, the company has consistently produced positive operating cash flow in both years. This is further supported by specific data points on page 43 and 44, which show that the 9 months ended November 29, 2025, had a net cash provided by operating activities of $66.6 million. This consistent generation of positive operating cash flow suggests that the company's operations are profitable and able to generate sufficient cash to meet its financial obligations. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, the long-term debt decreased from $285,000 to $255,000 in November 2024. However, this trend was short-lived as the acquisition of UW Solutions in November 2024 led to an increase in average debt balance. Furthermore, outstanding borrowings under the term loan facility increased from $0 to $215 million by November 29, 2025. Consequently, interest expenses have also seen a substantial rise. The net interest expense for the 3 months ended November 30, 2024 was $1,044, but it jumped to $3,227 in the same period of 2025, representing an increase of $2,183. Similarly, the 9-month figure rose from $2,634 to $11,148, a significant increase of $8,514. The data suggests that the company's debt level and interest expenses have changed significantly over the past year, with a notable spike in both areas following the acquisition of UW Solutions. The company's performance can be analyzed by examining its various segments. The architectural metals and architectural services segments have consistently shown growth in earnings before interest, taxes, depreciation and amortization, EBITDA, and margin. These segments are considered well-performing. On the other hand, the architectural surfaces segment has experienced a decline in EBITDA, although its EBITDA margin has increased. The corporate and other segment has seen a significant decline in EBITDA. The performance surfaces segment does not provide clear indication of performance. The architectural glass segment also lacks clear indication of performance, but it is not mentioned as failing either. The architectural services segment's operating income and adjusted EBITDA have declined, but specific data for this segment is not provided. Management is optimistic about the company's outlook, citing several key initiatives aimed at driving growth and profitability. In the short term, the implementation of Project Fortify is expected to yield significant cost savings, with an estimated $25–26 million in annualized pre-tax savings from Phase 2. Looking ahead, management envisions a long-term strategy centered around becoming the economic leader in target markets through differentiated product and service offerings. This will be achieved by actively managing the portfolio to drive higher margins and returns, as well as strengthening core capabilities through a shift towards center-led functional expertise. Financially, management is confident in the company's ability to meet both short-term and long-term needs, with adequate liquidity in place. Additionally, the company has the capacity to obtain debt financing for potential acquisitions, while also maintaining compliance with existing debt covenants over the next fiscal year. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts over the past few years. For instance, in 2024, it paid $16,238, while in 2025, this figure increased to $16,567. Furthermore, in the first 9 months of fiscal 2026, the company paid out a substantial $16.6 million. In addition to dividend payments, the company has also been actively buying back its shares. Between these periods, it repurchased a total of 12,063,207 shares. However, it's worth noting that no share buybacks were made during the 9 months ended November 29, 2025. This indicates that while the company does engage in share buyback activities, they may not be consistent across all time periods. There are concerns about inventory buildup in certain areas of the company. The total inventories, net, increased by $10.2 million from $92.3 million to $102.5 million on page 16. This increase is also reflected in raw materials and work-in-process inventories. However, a different trend is observed on page 30, where the inventories, net, show a significant decrease of $17,903 compared to previous values. This discrepancy raises questions about the overall inventory management within the company. That concludes the financial summary for Apogee Enterprises, Inc. Feel free to comment below, and I will be happy to answer them when possible.